Good afternoon, everyone, and welcome to our March webinar, Exploring Energy, Powering the Future. My name is Alex Picard, and I am part of the strategic client group here at Tortoise. And it's a pleasure to have market strategist and senior portfolio manager, Rob Thummel, with us today. So as we move further into 2026, energy has quickly become one of the more important sectors to watch in the markets this year. Geopolitical developments, particularly in the Middle East, have pushed energy back into the center of the macro conversation. Year to date, we've seen oil prices move higher and global gas markets tighten, reminding investors how quickly supply risks can ripple through the broader energy system. Over the past couple of weeks, our team has been fielding a lot of questions from investors about what all of this means for the energy markets, and I'm sure a lot of you have questions for Rob as well. So we will leave time for Q&A at the end of our prepared remarks today, but feel free to type those questions into the Q&A box on your screen at any time. So if you're new to Tortoise, welcome. We are energy specialists with more than 2 decades of experience in the sector. Today, we manage over $9 billion in assets with deep expertise across the energy value chain, from wellhead all the way to the end user. If we move to the next slide, you'll see our investment solutions at a glance. The majority of our assets, over $7 billion, are invested in energy infrastructure. We have roughly $500 million allocated to broad energy strategies, about $1.5 billion in electrification infrastructure, and just over $100 million in what we classify as energy adjacent strategies, which are businesses that support or benefit from the broader energy ecosystem. So on the next slide, you can see our full suite of investment lineup. Our 4 senior portfolio managers have worked together at Tortoise for more than 2 decades. They take what we call an all-of-the-above approach, meaning that they closely follow the entire energy infrastructure landscape. Even areas where we may not currently invest still need to be understood and monitored because they can influence parts of the market where we do have exposure. As our PMs identify structural trends and emerging opportunities across that energy landscape, we work with them to develop strategies that allow investors to participate in those themes. And our product lineup that you can see on your screen here today really reflects that and the evolution of the energy markets that we've seen over the past couple of years. A great example of this is the Tortoise AI Infrastructure ETF, ticker symbol TCAI. Over the past several years, our team began seeing a powerful intersection developing between energy infrastructure, data centers, and the build-out required to power AI. So launched last August, this strategy does capture that convergence between energy, digital infrastructure, and the rising electricity demand needed for that AI build-out. It also represented our first ETF launch in more than 6 years. Since seeding the fund with about $500 million last August, it has grown to roughly around $80 million today, reflecting that growing investor interest in the infrastructure required to support AI and power demand. We also launched 2 additional ETFs this past December, one focused on nuclear infrastructure and another providing MLP exposure within a RIC structure. And as mentioned earlier, our PM team will continue to evaluate new opportunities as the energy landscape continues to evolve. So before I pass it over to Rob, I think we have a couple of poll questions that we're going to ask the audience. And that first one that we'll pull up is, how significant do you believe the Strait of Hormuz disruption will be for global energy markets over the next 3 to 6 months? And Rob is going to dive into this topic in his prepared remarks today and what our team's thoughts are. So ahead of that, it'll be interesting to see how this audience is viewing those developments. Okay, so it looks like we have moderate to significant, Rob, based on what this audience thinks. So we'll see what your team is seeing. And then next poll, if we could pull that up. If tensions between Iran and Western allies persist, where do you expect oil prices to trend over the next 6 to 12 months? And again, Rob is going to talk about the scenarios their team is modeling and what this means for oil prices in his remarks also. Okay, looks like this audience, at least Rob, thinks we're going to kind of stay around where we are now, maybe push a little higher. So we'll hear what your team thinks about that when we move on. So just laying out the agenda for today, Rob's going to cover for us month-to-date and year-to-date performance of the sector, industry activity, as I mentioned, talking through the Strait of Hormuz and the impact that's had on the energy markets as well as oil prices. From there, we'll move into portfolio positioning, and then we'll wrap it up with some audience Q&A. So Rob, with that, I'll turn it over to you.
Thank you, Alex. Thanks everybody for listening. And let's go to the next slide. We'll just talk about we'll quickly flip through what's been going on. It's been a wild month already, and just this month, and we show you here that so far technology's bounced back a little bit. Materials, consumer staples have gone the other way. Probably a little bit of a rotation trade, and we'll talk about how that shakes out in the year to date as well. If you go to the next slide. So really what I look at every day and the team is, what's going on in the energy sector across the value chain. Really interesting things going on here, Alex. If you look at it, European natural gas prices, that's not a misprint. They're up 79%. Oil's up 27%. Why? Well, we all know, and we'll talk a little bit more about it. And Alex mentioned in the beginning, the Strait of Hormuz is effectively closed or almost closed, and that's been wreaking havoc on global energy prices. And natural gas is such an important commodity, and I think what we're going to learn after this, when we look back post haze, we're going to realize, and it's taken a little while, but any of you that's listened to this podcast in the past and really over the last several years know how much we think that natural gas is going to be important going forward. Natural gas, not only domestically but globally, is becoming a really important commodity. Electricity is becoming the new oil. Electricity, how do you generate electricity? Well, natural gas plays a really critical role in generating electricity, and it's the primary role of generating electricity. So we'll talk a little bit more about this in the next couple slides, but the fact that European natural gas has risen by 78%, look what U.S. natural gas has done. It's only up about 8.7%, despite all of this havoc that's happened. The reason for that, big reason for that difference is simply energy security. The U.S. has energy security. We produce more natural gas. All of you know this. We produce more natural gas than we consume in the U.S. So we have a lot of excess to export. But because of this, the fact that international gas prices have gone up so much, this is going to benefit some of the companies that we invest in that are transporting natural gas, whether it's through liquefied natural gas or just getting that natural gas to these various places where it is liquefied and then shipped overseas. Now, I should preface this by saying, look, we nobody wins as part of this war. Nobody wins in a war. We hope these conflicts can get resolved and these tensions can be alleviated. But it does show you how important energy is, and I think what we've seen in these moves in prices, it really shows investors energy is really, really important. Natural gas and oil are here to stay, and the fact that the U.S. has energy security in that we're effectively net energy independent, that's a real competitive advantage for us. So let's flip on and go and see how we've done year to date. I think many of you know the energy sector, best performing sector in the S&P 500. I love to present this slide, and I'll leave it to others when it's not, and let them explain why we're not doing well. But the energy sector continues to do well. I think there's this big rotation going on, and many of you have heard of it. I think Josh Brown, who I like a lot, refers to it as HALO, heavy asset, low obsolescence trade that's going on in the market. Now, if you've been following Tortoise for a long time, Tortoise was basically founded and started because what I would call the HALO trade as well. But it wasn't just the last couple of years ago. This was decades ago in the 2000s when effectively investors didn't really ascribe much value to these hard assets, these pipelines that were generating stable, consistent, steady cash flows and that were growing their dividends, in that case, distributions. Instead, everybody was buying, well, they were buying tech. And so when tech sold off, Tortoise was buying the pipelines, was buying the low obsolescent heavy assets. They're absolutely critical. And that's what we still do today. That's what we've done throughout our history in Tortoise. We look at, as a portfolio team, we've looked at every single company, especially in the energy sector. We love the energy sector because it's absolutely essential, and we love the energy sector because there's really nothing that's going to replace it. We've tried multiple, I've invested in energy 30 years, multiple ways that we've looked to try to replace energy, multiple ways we try to replace oil and gas. It simply just doesn't work. Oil and gas is here to stay. Oil and gas represents over 70% of the total global energy supply, and that's not going to change over the next several decades. And so investors are finally rewarding these companies that are essential, that operate essential assets, that provide significant free cash flow. And so as a result of that, the energy sector has really catapulted itself as one of the best performing sectors in the S&P 500. Now it's been helped, and let's go to the next page, and supported by the higher oil prices. And we'll talk about why those oil prices are higher, but everybody knows it all has to do with the current conflict and the tensions with Iran and the Middle East. That has also led to, when you look across the energy value chain, what's performed the best is oil field services. I think there's an anticipation that we're going to do a lot more drilling in Venezuela, potentially, a lot more drilling potentially in the U.S. And maybe some potential drilling in Iran down the road. And so that's led the oil field services stocks that have just really tanked in the last couple of years to rebound this year and be some of the better performing stocks. Our bread and butter energy infrastructure is held in with the higher oil prices, the higher energy markets, up about 18% year to date, and performing really like we expected it from a fundamentals perspective. Let's go to the next slide then as well. Okay, so what's going on? Okay, Strait of Hormuz, and why does it matter? Who would have thought that 20 miles a waterway would matter and could have such an influence on the global economy? But it does. And you've all heard it. And if you've listened to our webinars, I'll try to be brief, but I'm happy to answer any more questions about this. It's a 20-mile waterway, basically, that 20% of the crude oil and the natural gas in the world has to go through. And so it's a really, really significant choke point, really significant piece of infrastructure that when it gets disrupted, it can wreak havoc. And I should say, like I said, I've been investing in the energy sector for 30 years, and I've never seen an environment like this where we've had disruptions to this degree. So what's going to happen, and what impact it's going to have on the oil price? We've seen it. We've seen oil prices up $15, up 15%, down 15%. I think we're down 15% today because potentially the Navy is escorting some oil tankers through the Strait of Hormuz. But if we go to the next slide, we published a paper back in I think it was the 15th of January. And we documented, and it's on our website if you're interested in it at tortoisecapital.com, of why the Strait of Hormuz is so important. But more importantly, what's going to happen to the oil price, and what do we think oil prices and how they're going to be impacted, depending on what happens to the Strait of Hormuz. And for the most part, I think we've been pleasantly surprised. Expectations have pretty much been met with the price. So if you look at where we thought the oil, at the time, the oil price was probably around, we started the year at $55 a barrel. At the time this, I think this war began, oil was $60 to $65 right beforehand. So there's maybe about a $5, maybe $10 premium, geopolitical risk premium in oil prices. But we've all seen prices really escalate. And why? Well, it's because the probabilities of the world moving to our most, I guess, high price scenario have increased. And that most high price scenario is if there is an extended closure of the Strait of Hormuz, once again, which 20% of the crude oil supply goes through, then we would see $100 plus oil. And so that's what we've seen over the last couple of days, as effectively there have been no ships go through the Strait of Hormuz. Very, very little, very, very little activity. And so that's had implications upstream. And it's clogged up the system, right? So Iraq filled up its storage tanks. Saudi Arabia filled up its storage tanks, or is filling up. Kuwait filling up its storage tanks. So all of those countries, some of the largest oil producers in the world, have had to slow down, produce less oil, take supply off the global markets because these ships are unable to move through and transverse through the Strait of Hormuz. Now, all that, I want to make a clear statement from Tortoise's perspective. There is plenty of oil in the world. If we can get the Strait of Hormuz unclogged and it can keep moving, then we will see more reasonable oil prices. And we think that will happen over time. It's just a matter of time.
Great. Thank you, Rob. Then before we open up for Q&A, could you wrap it up for us, Rob, by shifting to portfolio positioning?
Yeah, go to the next slide. So most of you know our core strategies: energy infrastructure, broad energy, and electrification infrastructure. Energy infrastructure, pretty much these allocations have pretty much stayed pretty consistent. Still love natural gas, the natural gas pipelines, and owning companies that operate the largest natural gas pipeline network in the world are really a strategic advantage. The U.S. is going to really win this AI infrastructure war. I don't want to call it a war. I would say the AI is going to win. The U.S. is going to win AI infrastructure or AI because of our infrastructure. And so the U.S. will win with our natural gas pipelines and all the other AI infrastructure, the data centers and everything that we have. And because we have low cost energy, low cost natural gas, that's what's going to help the U.S. win this AI global race. And so we haven't really changed our portfolio positioning that much, whether it's broad energy, electrification, or on the next page, if you go to our AI, I think we have our AI infrastructure allocations there as well. We haven't changed those much as well. And as Alex mentioned, we recently launched, sorry about that, a nuclear fund that focuses on nuclear as an opportunity to provide electricity going forward, because not only will natural gas be important going forward, but nuclear will be a really, really important component going forward of generating electricity. And I can't remind people enough, when you look at how much electricity the U.S. needs to generate between now and 2050, it's equivalent of the same amount of electricity that's generated in Japan. And Japan's like the fifth largest economy in the world. There's a significant amount of electricity that needs to be generated. We're going to need all forms of energy to meet this need, and it's all going to be needed because we want to win this this global AI race. So, back to you, Alex.
Perfect. Thank you, Rob. Okay, we will move into Q&A now. And as a reminder, you can type that Q&A into the box on your screen. If we don't get to your question, we will make sure that we follow up with you to get that answered separately. So Rob, we did have a few questions come in while you were talking. First one here, how different the U.S. energy position looks today compared to previous geopolitical crises. And you did touch on this specifically, or particularly with the LNG exports in your remarks, but could you expand on that a little bit?
Yeah, absolutely. This is really crucial, and it's really important, and everybody knows this, but I can't tell you how important it is that the U.S. now is the largest producer of oil and gas in the world, and the largest exporter of energy in the world, because it just totally changes the game for the U.S. if you think about it from an energy security perspective. And so, look at what's happened in crude oil prices. Brent prices are up, which are more of the global price, are much higher than WTI, U.S. prices. So U.S. oil prices are much lower. So gasoline prices in the U.S. will be lower than they are internationally, simply because the fact that the U.S. has produced so much crude oil over just the last few years because of the energy sector and the shale technology. I guess I can't imagine what the oil price would be if the U.S. shale industry was not producing the amount of oil that we're producing today. It would be significantly higher. But it's even more exaggerated if you look at natural gas. I showed you earlier how much European natural gas prices have increased. Significant amount. U.S. natural gas prices have gone up, but not much since these tensions have elevated. And that low cost of natural gas really helps the U.S. from a competitive advantage perspective, because we have a low cost of energy. So you can do a lot with having the lowest cost of energy. Electrification, which is going to be a big theme for the next several decades. The U.S. will win that because of the low cost of natural gas and the low cost of electricity generated using natural gas. We'll win the AI race because of the low cost of electricity, because of the low cost of natural gas. Industrialization, we can reindustrialize a lot and bring industries back to the U.S. because of the low cost of natural gas. So I can't emphasize enough how critical it is to be, I guess, energy secure. Energy security is really important, and obviously countries around the world are going to be buying even more liquefied natural gas, buy more oil from the U.S. Because the world needs more energy and the world needs more U.S. energy.
Thank you, Rob. Okay, one of the biggest reactions we've seen so far has been in the global natural gas markets. Can you talk about why LNG markets tend to react so quickly to disruptions in the Middle East?
Yeah, sure. So you saw what happened when Qatar was struck by a drone, by an Iranian drone. Qatar is the second largest producer of liquefied natural gas in the world. Obviously, natural gas, that's the primary reason why international natural gas prices started to rise and have risen so dramatically. If you think about the LNG industry, how important it is, natural gas is important to the U.S. It's also really important to other countries around the world as well. China, Asia, South America, Europe, and so the liquefied natural gas market has really evolved over time. It wasn't that long ago, and it's really developed into its own industry. If you think about it, we were importing natural gas in the U.S. Once again, if we didn't have all the natural gas thanks to shale technology, I don't know how much we would be paying countries like Russia and Australia and other countries around the world to buy natural gas for us to consume here in the U.S. But we don't have to do that. We get to take advantage of the low cost natural gas that we have here in the U.S. And the industry's really developed as well. If you think about it, today we probably export 15 billion cubic feet a day of natural gas. It's a $60 billion a year industry. We're probably going to double that here in the U.S. because of the massive amount of supply of natural gas in the U.S. And so we really think that the LNG industry will play a really critical role, not only domestically, but also globally in ensuring that economies continue to operate and companies that we're investing in on the energy infrastructure side will play a critical role ensuring that the U.S. can be a reliable, secure source of natural gas supply for not only just years or days or months, but for decades to come.
Great, thank you. Shifting to oil, could you talk about what countries are most exposed to higher oil prices?
Yeah. So where does all that oil that goes through the Strait of Hormuz, where is it going? It's the biggest consumers of oil obviously are the U.S., China, India is right up there as well. All the growing economies. It's been very, there's obviously a clear link between economic growth and oil demand. The great thing about all of that, though, is the U.S. is a large consumer, but we're obviously the largest producer as well. And so in the U.S., you benefit from that, and economic activity can continue to be successful because you've got the needed oil to continue to grow the U.S. economy. Also, we export some oil as well. Now, China and India are experiencing some more challenges, right? or China in particular has tried to stockpile oil, but if we continue to see a long duration closure of the Strait of Hormuz, we're going to see higher oil prices, and that's going to have an impact more so on countries like China and India, and less so on countries like the U.S., where we're producing most of the oil that we consume.
Great, thank you. Now shifting over to Bitcoin mining, could you talk about the role of digital infrastructure companies such as TeraWulf or Cipher in the role of the AI value chain?
Yeah, no, well, I'm glad you asked about Bitcoin mining, Alex. It's one of our favorite topics here. Many of you know we look at all across the energy value chain. We look at everything. We look at all energy technologies. We uncover every rock looking for investment opportunities. This is Bitcoin mining. Actually, a lot of you are thinking, probably scratching your heads thinking, what is this guy going to say about Bitcoin mining? This was an opportunity uncovered by some of our analysts to do fantastic work here. Reason why we like it, and the reason why we've been successful at it, is because we understand the electricity component of it. And a lot of these Bitcoin miners started out by simply getting access to electricity, and they built their Bitcoin mines in areas, let's say Texas, and got access to cheaper electricity in the U.S. And then what they figured out is, you know what? Rather than be a volatile Bitcoin miner, why don't we transform our business into to a stable, steady data center operator? And they did that by basically taking those power contracts and building shells or data center shells and using those power contracts. And when they transformed their business from being volatile Bitcoin miners to long-term contracts with high-quality counterparties with steady cash flows, those companies re-rated. They re-rated much higher. Kind of like what you see when oil and gas pipelines basically are spun out of more volatile commodity businesses. And so we've seen that happen in TCAI, in our Tortoise Capital AI Infrastructure Fund, and identified several of them. They've got great ticker names, like Alex mentioned one, TeraWulf, Riot Platforms is another one that you'll see us invest in. But they're the businesses we like to see where we identified the opportunity that nobody else was recognizing, which was the electricity that they had. And then we also recognized that they were going to transform their business. And as they've transformed their businesses and re-rated, that's really helped our performance, in particular in TCAI.
Great. Thank you, Rob. I think we'll do one more here. And then again, if we didn't get to your question, we'll make sure we follow up with you. But given the combination of geopolitical risks, supply constraints, rising energy demand, can you talk a little bit about how investors should be thinking about energy exposure in portfolios, especially in relation to energy's percentage of the S&P currently?
Yeah, that's a good, very good question. This is a question we get a lot, Alex, and I know you field it a lot as well. So energy as part of the S&P 500 is, I think it's like 3% or so, I believe, of the S&P 500. But when you add utilities in, you start adding in some other elements to it, you can easily get to an energy allocation. I think it should be as much as 10% of your portfolio, and maybe even more, because if you think about it, energy is so critical, right? And I think we're learning this real time. We're living today how important energy is. If you don't have oil and gas, we are seeing what happens to economies. And so the fact that the U.S. energy sector is so important, and it's so important because it's going to keep this economy in the U.S. competitive, not only just competitive, but we're going to have a competitive advantage because of low-cost energy that the U.S. energy sector really allows, because of oil and gas drilling, in particular shale drilling, and one of the most significant technologies, shale technologies, that I've seen in my 30-year career. That's why there should be an allocation, I think, that's well above what energy represents in the S&P 500, and I think you should combine the utility and maybe even the industrial allocation as well, and look at an allocation of at least 5%, maybe as much as 10% to the energy sector. And as we all know at Tortoise, we've got a variety of products that offer opportunities to play the energy sector and adjacent energy sectors in a variety of ways.
Perfect. Thank you, Rob. So with that, we'll go ahead and wrap it up. Thank you all for joining us. Again, we'll reach out if we didn't get to your question. April 9th will be our next monthly webinar. But in between now and then, our team will continue to publish our thoughts on the geopolitical events happening in the world today. We've published some articles. We've done some special podcasts. So be sure to look out for those. If you have any one-off or specific questions, our team is always ready and willing to answer via email, jump on a call. You can see our contact up on the screen there. And we look forward to seeing you on another Tortoise podcast. Thanks, Rob. Thanks, everyone.
Thanks, Alex. Thanks, everybody. All right.